Gold has always occupied a unique position in the world of money, investment, and human psychology. For thousands of years, it has been trusted as a store of value, a symbol of wealth, and a form of protection during uncertain times. As the global economy moves through periods of instability, rising debt, inflation concerns, and shifting political alliances, gold once again finds itself at the center of attention. Looking ahead to 2026 and beyond, conversations about gold's future price have become louder, bolder, and more controversial than ever before. The precious metals market is filled with opinions that often contradict one another. Some analysts argue that gold is already overpriced and due for a correction, while others believe the metal is only at the beginning of a much larger move higher. Forecasts vary widely, reflecting not only different data sets but also different interpretations of how the global financial system is evolving. What makes this period especially interesting is that gold has already exceeded many expectations, forcing even cautious observers to rethink their assumptions. Predicting prices is never an exact science. Markets are influenced by countless variables, many of which cannot be measured or predicted with precision. Economic data, government policy, investor sentiment, geopolitical events, and even cultural behavior all play a role. Because of this, no prediction should ever be treated as a guarantee. Even the most experienced professionals can be wrong. Still, when certain analysts speak, their views tend to carry more weight because of their history, reputation, and influence. One such analyst has recently drawn attention with a bold outlook for gold in 2026. His projection suggests that gold could rise significantly higher than current levels, surpassing what many thought was realistic just a few years ago. This forecast has generated strong reactions, ranging from excitement to skepticism. What makes it worth examining is not only the number itself, but the reasoning behind it and the track record of the individual making the claim. Before considering any price targets, it is essential to stress the importance of personal responsibility in investing. No one should make financial decisions based solely on the opinion of another person, regardless of how experienced or confident they may appear. Gold, in particular, should be viewed through a long-term lens. It is not a get-rich-quick asset, nor is it immune to volatility. Instead, it is traditionally served as a form of financial insurance, offering stability when confidence in other assets weakens. Gold's long history supports this role. Across civilizations, gold has been valued not because it produces income, but because it preserves purchasing power. It does not corrode, it is scarce, and it cannot be created at will. These characteristics have allowed gold to maintain relevance even as currencies have risen and fallen. In the modern era, despite the dominance of digital finance, gold continues to play a critical role in both private portfolios and national reserves. In recent years, gold's performance has been particularly notable. Prices have reached record highs even after accounting for inflation. This strength reflects deeper concerns about currency debasement, government debt, and long-term economic stability. As central banks expand money supply and governments run persistent deficits, many investors seek refuge in tangible assets. Gold often benefits in such environments because it exists outside the traditional credit system. The analyst at the center of current discussion argues that these conditions are not temporary. According to his view, the same forces that pushed gold higher recently are still in place and may even intensify. He points to continued central bank buying, strong investor demand, and limited growth in mining supply as key drivers. Because gold has already surpassed earlier targets faster than expected, he believes higher price projections are justified. This analyst is not an outsider or a sensationalist. He has spent decades working in high-level roles at major financial institutions and has advised large investors on market strategy and economic trends. His research firm is widely followed, and his commentary frequently influences how professionals think about asset allocation. Over the years, he has made several high-profile calls that later proved accurate, helping establish his credibility. Among his past successes are early forecasts of major stock market milestones and warnings about risks building within the financial system before major downturns. While no analyst is correct all the time, a consistent ability to identify long-term trends adds weight to his opinions. That history explains why his latest outlook for gold has attracted attention from both supporters and critics. According to his revised forecast, gold could reach levels by the end of 2026 that would place it among the most significant bull markets in its history. He believes investor psychology has shifted in a way that favors hard assets over financial promises. Exchange-traded funds linked to gold have seen renewed inflows, suggesting institutional participation remains strong. At the same time, a retail interest continues to grow as individuals seek protection against economic uncertainty. Beyond the mid-decade outlook, his longer-term projections are even more dramatic. He has suggested that gold could climb substantially higher by the end of the decade if current trends persist. These statements naturally provoke debate. Supporters argue that rising debt, geopolitical fragmentation, and declining trust in fiat currencies support higher gold prices. Critics counter that extreme forecasts often appear near market tops. Both perspectives deserve consideration. Markets rarely move in straight lines. Strong rallies are often followed by corrections, periods of consolidation, or sudden reversals triggered by unexpected events. Timing these moves is extraordinarily difficult. History shows that even assets with strong long-term fundamentals can experience sharp short-term declines. This reality underscores the importance of humility when discussing price predictions. Market psychology adds another layer of complexity. Prices are driven not only by supply and demand, but also by perception and narrative. When enough people believe an asset will rise, their collective behavior can push prices higher, sometimes beyond what fundamentals alone would justify. Conversely, shifts in sentiment can cause rapid sell-offs. Understanding this psychological component is essential when evaluating bold forecasts. Despite these risks, many investors continue to view gold as a valuable component of a diversified portfolio. How one holds gold depends on individual circumstances, including budget, risk tolerance, and investment goals. Some prefer large bars or coins, while others focus on smaller, fractional pieces. As prices rise, fractional gold often becomes more accessible, allowing gradual accumulation without large upfront costs. Physical ownership carries a unique appeal that financial products cannot replicate. Holding gold in one's hand provides a tangible sense of value and permanence. Unlike digital assets or paper claims, physical gold does not depend on a counterparty. This characteristic becomes especially important during periods of financial stress when trust in institutions may decline. Central bank behavior further supports gold's relevance. In recent years, central banks around the world have been accumulating gold at a pace not seen in decades. This trend reflects a desire to diversify reserves and reduce reliance on any single currency. When institutions with long time horizons continue to favor gold, it sends a powerful signal about its perceived stability. Cultural demand also plays a significant role. In many parts of the world, gold is deeply embedded in tradition, particularly in weddings and festivals. This demand is not driven by speculation, but by custom and social values. As a result, it tends to be resilient even during economic downturns. Such consistent demand provides a strong foundation for the market. Industrial use, though less discussed, adds another dimension. Gold's unique properties make it valuable in electronics, medical devices, and other specialized applications. While industrial demand represents a smaller portion of total consumption, it still reduces available supply. Every ounce used in industry is one less ounce available for investment or jewelry. When all these factors are considered together, it becomes clear why some analysts remain optimistic about gold's future. Their confidence is not based on a single variable, but on a complex interaction of economic policy, global behavior, and human psychology. Whether the most ambitious price targets are reached remains uncertain, but the underlying arguments are not easily dismissed. Ultimately, each individual must decide how gold fits into their personal financial strategy. Some will hold a modest amount as insurance, others may allocate more heavily, and some may choose not to participate at all. There is no universal solution. What matters is making informed decisions based on careful thought rather than emotion or hype. Listening to experienced analysts can provide valuable perspective, especially when they highlight risks or long-term trends. However, their views should serve as guidance, not instruction. Blindly following any forecast is dangerous. Markets reward patience, discipline, and independent thinking over time. As the discussion around gold's future continues, the coming years will reveal which predictions were closest to reality. Regardless of short-term price movements, gold's enduring role in global finance seems secure. Its ability to inspire debate, caution, and confidence simultaneously is a testament to its unique place in human history. For many, that alone is reason enough to keep paying attention.